Welcome to this explainer. If you're a focused learner looking to cut through all the noise and understand exactly where the technology and financial markets are heading right now, well, you are definitely in the right place. Today, we're looking at a massive cross-sector macroeconomic shift that really crystallized in April of 2026. Across multiple industries, we saw a definitive pivot. The dust has finally settled, that wild speculation has cooled off, and what's emerged is something so much more profound. We are talking about the great shift from hype to actual, literal infrastructure. Okay, let's dive right into this fundamental shift. The transition we've just experienced is incredibly stark. On the old side of the ledger, we had a narrative totally driven by hype. Wild speculation, meme-driven rallies, and a lot of untested promises. But today, the new narrative is entirely grounded in infrastructure, strict compliance, and actual measurable usage. What the April data unequivocally shows us is that across all major tech sectors, the market narrative has grown up. Capital is demanding institutionalization, and honestly, nowhere is this more apparent than in our first sector. Section 1. Crypto gets institutionalized, with Bitcoin leading market maturation. $2 billion, right? In just the month of April alone, nearly $2 billion flowed directly into U.S. spot Bitcoin ETFs. That is a staggering figure. And when you pair it with Bitcoin's pretty impressive 12.07% monthly gain, it tells a very, very clear story. This isn't your average retail FOMO anymore. This is renewed, absolutely serious institutional demand. The heavy hitters have arrived, and they are allocating massive amounts of capital. So the really crucial point here is how this institutional capital actually behaves. We're seeing a dramatic rotation of capital away from highly speculative, smaller altcoins. Instead, all that money is flowing upward into established, highly liquid assets, which is causing Bitcoin dominance to steadily rise. It's a classic flight to quality. The market is loudly telling us that in a maturing industry, investors just want the proven infrastructure of the market leader. And this perfectly illustrates our point about infrastructure. You literally can't have institutional adoption without institutional guardrails. Just look at this advancing U.S. crypto rulemaking from April. We're seeing concrete frameworks for stablecoins and payments. We've got the Genius Act proposals actively moving forward. Regulators are finally providing clearer token classifications and updated anti-money laundering or AML guidance. Accelerating regulation isn't stifling the market anymore. It's actually creating a much safer, compliant environment for those massive institutional players to operate in. But hey, quick aside, we still need to keep our eyes on the underlying mechanics. While the macro market is maturing, native crypto dynamics still play a huge role. Token unlocks and liquidity events remain absolutely key watch items for major ecosystems, specifically networks like Sui and Arbitrum. As new tokens enter the circulating supply, it obviously impacts liquidity and price action. So while the institutions are out there buying up Bitcoin ETFs, the nuanced investor definitely still needs to monitor these specific ecosystem events carefully. Moving on to Section 2. AI enters the enterprise, moving beyond the chatbot. Think about how fast this has evolved. Step 1, we had the era of simple chatbots, answering basic questions, generating simple text. That was kind of the hype phase. Step 2 brought us multi-step workflow systems, where AI could actually handle a sequence of connected tasks. But Step 3 is where we landed in April, autonomous enterprise agents. We are shifting from AI as a simple conversational tool to AI as a highly complex system capable of independently performing, managing, and executing multi-step business operations. It's a real game changer. A massive catalyst for this shift hit this past April when Microsoft launched its proprietary in-house MAI models for enterprise. Why does this matter? Well, because it proves that the largest platforms in the world are no longer content relying entirely on outside AI labs. They're building their own proprietary model stacks from the ground up. It's a crystal clear signal that AI is becoming foundational infrastructure, deeply integrated right into the enterprise ecosystem rather than just some outsourced plugin. So what are companies actively prioritizing right now? Distilling the practical signals from April, we see 3 major focuses. First, they want those in-house or differentiated foundation models we just talked about. Second, they're heavily investing in AI agents for their employees, customer service, security, and daily operations, pushing for multimodal, real-time, tool-using models. And third, they are demanding lower-cost deployment through specialized infrastructure. The enterprise doesn't just want an AI, they want a cost-effective, specialized AI workforce. All right, Section 3, the DAI convergence, where crypto and AI meet. Decentralized AI, or DAI. This is unequivocally one of the strongest, most vital narratives to emerge from the market this past month. DAI represents emerging protocols that seamlessly combine artificial intelligence compute, massive data assets, and crypto token incentives. It is quite literally the perfect marriage of AI's brain power and crypto's decentralized infrastructure. Let's break down the recipe here and see exactly how capital is rotating toward protocols that mix these specific ingredients. You need massive compute resources to train and run AI models. You need vast data assets to make those models actually intelligent. But historically, these have been totally controlled by centralized tech monopolies. By injecting the third ingredient, crypto token incentives, DAI protocols coordinate thousands of independent individuals globally to share their spare compute and their proprietary data and then rewards them with tokens. They are crowdsourcing the exact infrastructure needed to compete with the tech giants, essentially solving real-world monopoly problems. So that old rigid split between crypto over here and AI over there, it's rapidly narrowing. Investors are realizing that AI absolutely needs decentralized computing to scale efficiently, and crypto needs the massive utility of AI to drive real-world adoption. This convergence proves that the market heavily favors infrastructure with measurable usage over isolated speculative tech themes. The silos are completely breaking down. Which brings us to Section 4. What matters most now? Stripping out the noise. Here's your summary, the 4 ultimate takeaways to keep in mind. Number 1, Bitcoin has unequivocally regained momentum, drawing incredibly strong multi-billion-dollar ETF inflows. Number 2, crypto regulation is finally becoming concrete, establishing the exact compliance needed for institutional safety. Number 3, AI has completely moved past the novelty phase, pushing deeper into serious enterprise deployment with proprietary models and autonomous agents. And number 4, both of these matured sectors have merged, with DAI emerging as the ultimate bridging narrative between the two. Both of them really grew up independently this month before finally converging. Which leaves us with a final, pretty provocative thought. As AI and crypto seamlessly merge together into this new DAI nexus, is the ultimate infrastructure of our digital future destined to be decentralized? It's a fascinating question, for sure, and one that will undoubtedly shape the markets in the months to come. Keep exploring, keep questioning, and I look forward to diving into the data with you again soon.